Morning. How to recession-proof your portfolio, the latest on the Secure Act, plus the impeachment inquiry and what the markets are thinking. All this and more on tap on Dollars and Cents. My name is Joel Garris of Nelson Financial Planning. You're listening to News Radio WFLA Orlando, broadcasting on a bunch of different networks now, so you can hopefully get a good signal no matter where you are. So I don't know about y'all, but I'm already getting a little tired about the round-the-clock impeachment news. Nothing beats the ability of the media to latch on to a subject and grind it and grind it and grind it. Certainly, these are important questions that are getting asked in Washington, but in terms of the economy and the markets, what did we see this past week from the markets? Pretty much a big yawn. The Dow basically flat for the year, I think, for the week. I think technically it was actually down like 100 points, so not really much of a movement at all from the market. So a big yawn from them. The perspective, if we look at some prior presidents that have gone through the impeachment process, we have Richard Nixon. And so his impeachment process started in February of 1974. Lasted until such time as he resigned. It looked like that one wasn't really going to go his way. During that period of time, the markets declined by 13%. If we look at the other more recent impeachment process, that, of course, would be Bill Clinton. And from 1998 to 1999, to his acquittal in the Senate in 1999, the markets actually rose 28%. So I don't think that there is a distinction or a correlation that you can draw between what the markets are going to do and an impeachment in Congress. Certainly those would say those were mixed results. You had one where the market was up quite a bit, and then the other where the market was down. I think it's more instructive to sort of look at where the economy is relative to that period of time. If you look at Nixon's time period, you were still working off the shocks of the OPEC oil embargo, and so there was definitely a weaker economic conditions during that period of time. I think the market ultimately reflects more of those economic conditions than whatever the headlines are coming out of Washington. Similarly, if you look at Clinton's time, 98, 99, that was the run-up for all of those tech companies, the Y2K buildup. And so certainly you had some economic growth numbers that were pretty strong, and that ultimately propelled the market. If we look at sort of where things are now for the markets, hard to believe that the third quarter of this year comes to a close tomorrow. Tomorrow is September 30th, and then Tuesday will be October 1, and that will wrap up the third quarter for 2019. We did a little video recap last week that we'll post, I believe, starting tomorrow, that gives you our minute summary of the third quarter. Obviously, we think it's important to tune into the radio program to get a little bit more perspective than a minute, but I'm told that the normal world out there that looks at stuff online has a limited attention span. So hopefully in radio land, people have a much stronger attention span than on social media. We'll leave it at that before we jump to too many conclusions on it. But we'll be posting that tomorrow in terms of a third quarter recap. The reality is for this third quarter, the markets were basically up just a little bit. And so when you get your quarterly statements, you'll sort of see that little bit of a movement if you follow our investment approach on a regular basis and on a consistent basis. Then you'll see sort of that little bit of an upward tick for this third quarter. Remember, the first two quarters were pretty strong. So overall for the year, pretty decent. But if you take a look back and sort of pan back a little bit, the reality is that the markets really haven't done much over the course of the past year, because the reality is that this year it was really more about recovering from that nearly 20% drop that occurred last November and December. So if you look at the past 12 months, the markets are basically flat. And even further than that, if you go back to January of last year, so January 2008, now almost 2 years, the overall markets are only up about 3% overall. So it's been a very muted response. Much of the headlines and much of what the market is doing really over this past couple of years is reacting to more the China headlines and the news that comes out from those trade negotiations. If it's good news, then we see the market accelerating upward. If it's bad news, we see the market declining. Layer on top of that, of course, interest rates. I think now the Federal Reserve has at least gotten that part right and not raising interest rates anymore. We suspect, though, that perhaps they shouldn't be cutting them anymore either. At some point, you want to preserve some ability to cut rates, because if you run into a tougher economic time, then lowering rates is certainly a good way to combat whatever the economic weakness is. So at the end of the day, I think if we look at the markets over what they've been currently doing, I think it's really more about China and how that ultimately plays out that will drive market performance in the short term. I don't believe that this impeachment stuff, other than generating the normal headlines and the normal shorter intraday or weekly reaction in the market, really won't be anything to get too terribly concerned about. I think the more important issue is China, and certainly history suggests that the markets behave more related to what's going on in the economy than what's going on in Washington as it relates to impeachment. You can look at Nixon versus Clinton. One, the market was down. The other, the market was up. Really no good conclusion to draw on those. I think the better conclusion is to look at what's going on in the overall economy. And certainly we'll continue to have a better feel for that in the weeks ahead. As we mentioned, it's the end of the third quarter, which means that corporate America will begin to roll out its earnings announcements here in the next week or two. And I think those are always the more important pieces of information to look at, is to see how profitability is going among corporate America. So I'm sure going forward in the weeks and months ahead, we'll have much more to say about the impeachment process, assuming that it continues on in the form that it certainly appears like it's going to continue based upon this past week. But remember, I think the markets are much more interested in the economic data than the Washington data. It's rapidly becoming much more of a reality show in Washington than ever before. But stay tuned on that. I'm sure we'll have much more to say on that. We're going to slide to a break. When we get back from the break, we're going to continue the conversation about our client meeting last week that we had, one of our regular client meetings that we have throughout the course of the year, and to talk a little bit about the important conversation we had last week involving technology companies, and this growth versus value distinction. So we'll cover that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA. Welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio WFLA Orlando. Dollars and Cents, Central Florida's longest running radio program. I am Joel Garris of Nelson Financial Planning, the host of the program. And on the program today, if you missed that first part, we talked a little bit about the impeachment stuff. Certainly that's commanding a lot of headlines. Then on this segment, we're going to talk a little bit about the client meeting that we had last week that really continues to draw that distinction between growth versus value. Those old growth companies, the definition that existed 20 odd years ago just isn't quite the same. And we'll talk a little bit about that. Plus, update you on the Secure Act and how to recession proof your portfolio. Plus, of course, as we do each and every week, we'll be happy to add your topic to the list of conversation. And in order to do that, you just need to simply follow the instructions that Bud aptly gives at the beginning of every segment, or I'll give them to you now. 407-916-5400. Toll free 1-866-916-5400. Those are the numbers to call on in and be a part of the program. Or you can send an email. That email, Joel, Joel, at NelsonFinancialPlanning.com. Those are the ways to which you can get in touch with us on the program and add your topic to the mix. So, as you all know, we at Nelson Financial Planning believe a lot in educating and the power of education for our clients. And so consequently, every year for 20, 30 years, we have a series of meetings where we bring in industry professionals from the industry to talk about the economy, to talk about tax changes, sometimes to talk about politics. And those folks visit with us and our clients on a regular basis. We usually, as the schedule allows, usually about one a quarter, one sort of late January, early February, usually late March, early April, and then one in September, and then a breakfast session in November. So we had our September one just this past week. Interesting conversation about a distinction that may not have the traditional distinction that it used to have. And that distinction is this distinction between growth companies versus value companies. This is a concept that has been out there in the investing world for decades now, but the definition may have to get tweaked a little bit simply because what's traditionally thought of as a growth company. So a growth company is one where its earnings are expected to grow, but typically that growth or that extra earnings gets reinvested back into the business. So if you've got growing earnings or growing revenue, capturing a greater market share, adding more clients, generally the traditional thought is, okay, well, that would put you in the growth side of things. And what happened in the 90s is that sort of became a synonym for technology companies because those companies were growing at such a rapid pace that growth and technology sort of got mushed together, if you will. Meanwhile, a value company is traditionally thought of as a dividend-paying company. So they might not necessarily have the same growth prospects year over year over year, but they have a very stable business model such that with their cash flow, it's so stable that they have committed to paying out a dividend. And the reality is that if you are a business and you start to pay a dividend, one of the worst things that you could do is all of a sudden stop or have to lower that dividend. So value companies or dividend-paying companies are generally thought of as those that just have a little bit more, are more mature and have a little bit more of a stable cash flow, hence the name of value versus a growth. But the problem is that a lot of the technology companies of the 90s, those that are still around and managed to go through Y2K and the like relatively solidly, are in fact very different in terms of how their business models make. A great example that we use when we talk about this with clients is Microsoft. Microsoft, back in the 90s, if you recall, when they were selling their software, right? How did you get a hold of that? Well, you bought it on like some floppy disks, or maybe eventually you wound up buying it on a CD. And that CD had like a key code that you would put in and then be able to upload their software. Okay, so it was a product that everybody would purchase, but that was ultimately generating a lot of growth because more and more people were purchasing it because more and more people were buying computers, and so the computers were becoming much more ubiquitous across society during the course of the 90s. Well, the reality is what also was happening was because you had a floppy disk, because you had a key code, there was oftentimes a lot of sharing, if you will, of that disk between your buddies, between your coworkers, whatever the case may be. And so consequently, Microsoft's business was much more of a transactional nature, growing. So it was more of certainly a growth company, but more of a transactional nature, if you will. Fast forward 20 years, and Microsoft's business model obviously looks very different than it did back then. Number one, you can't buy the floppy or the CD or what have you with the program on it. All of that is downloaded from the internet. And what happens when you download something? Well, enough information gets passed back and forth on that download so that Microsoft knows that's the computer that this software should be on. And it shouldn't be on your buddy Joe's computer. Buddy Joe is going to have to buy a separate license. And oh, by the way, let's just make it so it's super easy so that when you buy our software, it just automatically renews and we just automatically charge your credit card. Pretty good business model when you stop and think about it. So the entire business model of Microsoft has really shifted to much more of that recurring revenue model. Almost, you could argue, like your good old-fashioned utilities, which are often thought of as your traditional value types of companies because utility company provides power, you pay the bill, it's the same thing each and every month, it's pretty stable. In a lot of respects, you could argue that same thing about Microsoft and the way that its business functions today. So what's interesting about that is then how could you categorize Microsoft really as a pure growth company when it has such a stable business model that it has that regular ongoing cash flow? And I think that's where those lines start to get kind of blurred. So it's important to really look at the distinction between what types of companies that you own. Are they really truly value or are they growth? And at the end of the day, have they really been categorized properly? Because as we've talked about before on the program, we're going to talk a little bit about it here in the next segment. A dividend-paying company is one that is going to be a little bit more recession-proof, a little bit less volatile than a company that does not pay a dividend. So those are some of the important things to ask and to think about when you're looking at your investment portfolio. Another important thing to be thinking about and looking at when it comes to your investment portfolio is the latest out of Washington when it comes to the Secure Act. Now, if you're a regular listener to the program, you know that we've poked a few holes in that piece of legislation that has passed the House by an overwhelming majority. I think it was like 471-3. That's pretty overwhelming when both the Democrats and the Republicans can agree on something. But it has stalled in the Senate, hasn't gone anywhere in the Senate. The Senate, meanwhile, has a dueling version of that program. And so of that piece of legislation, we wanted to kind of give you some of those numbers on the program today, just so you can kind of see how this thing might evolve or ebb and flow. The biggest issue, well, we have two issues with the Secure Act, right? One is the massive lobbying that the insurance business did in Washington to get this thing passed. And we've talked about that on prior programs, the amount of quote-unquote grassroots campaigns, social media campaigns, call campaigns to really push this forward. Why? Because the Secure Act makes the option to get an annuity a much greater, more available option. So there was definitely some skin in the game for the insurance industry, and they absolutely lobbied the heck out of this to get it through. That's issue number one. Issue number two is a little bit more impactful in terms of your money, and that is the elimination of the Stretch IRA. Now, the Stretch IRA is the concept whereby if I inherit an IRA as a non-spouse beneficiary, I can spread that out over the course of the rest of my lifetime. The House version that passed basically said, okay, we're doing away with that, and you only get to delay that or defer that for a 10-year period of time. The Senate version, however, is a little different. The Senate version actually would exempt $400,000. So you would still have $400,000 that you would be able to use the Stretch IRA rules on. So that's great because it still preserves the ability to use that Stretch IRA on that piece. Where the Senate version also differs from the House version is that to the extent that it's more than $400,000, you only get 5 years to take out that excess amount. But I think I like the Senate version a little bit more because it still preserves this option, this powerful planning tool that you have when it comes to IRAs and being able to pass those to the next generation and have that tax deferral continue, have the tax on that account be paid out over an extended period of time. Those are all some pretty important planning features. Problem is, you listen to some of these politicians, and by the way, this is on the Republican and the Democratic side, their view is, well, this Stretch IRA concept was never intended to be a tool to pass wealth down to the next generation on an untaxed basis. And that is the piece that bothers those politicians up in Washington. They can't get their hands on this money fast enough to collect taxes on it. Well, if the insurance lobby can pull off a lobbying coup, maybe the American public can as well, and talk to their legislatures and say, hey, why don't you leave that part alone? You get enough money, perhaps you figure out a way to balance your own dollars rather than take it from mine. But hey, that's just a suggestion. Anyway, we'll take a break. When we get back, we'll talk about how to recession-proof your portfolio. We're going to come back to that value versus growth distinction we were just talking about as well, because that's an important part of the conversation. Here on Dollars and Cents, this is Joel Garris, Nelson Financial Planning News Radio, WFLA, Orlando. Hello, friends. Welcome back to the program. Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. If you're interested in calling into the program, we've got open lines 407-916-5400, toll free 1-866-916-5400. This segment of the program, we're going to talk a little bit about how to recession-proof your portfolio. And this is going to be a little counter to the traditional wisdom that's out there, because whenever you hear people talk about recession-proof my portfolio, you typically hear folks talk about it in terms of, well, let's change the mix of what you own between stocks and bonds. Let's boost up the bond piece and let's reduce down the stock piece. And we think that's a really bad idea. Because at the end of the day, what you're engaging in is nothing else except for market timing. The fact that you think you're going to be able to predict when the markets are going to go down and when the markets are going to go up, and you're going to adjust your allocation between stocks versus bonds in light of that fortune-telling ability, I would suggest that all you're going to do is reduce your long-term rate of return over time. The reality is that in the late stages of an economic cycle, you can often find strong periods of return in the market. Similarly, in the immediate aftermath of a market decline is also where you find some of the strongest market performance. So before you change that allocation, be careful, because that's not the way to do it, in our opinion. Now, what can you do? Well, there's a couple of concepts, and we've talked a little bit about them over the course of the past few months here. And one of them is really checking out that mix of growth versus value. But as we were talking about early in the program, you've got to really dig down a little bit more on exactly what that looks like, because your traditional sort of growth company may not really be fitting that growth model as much as it used to, particularly when you start to look at a lot of the technology companies out there today that have these recurring revenue models. We were talking about the example of Microsoft before, where it's a recurring revenue model. So that's almost as stable as your good old-fashioned utility, if you will, that is typically a dividend-paying type of more value stock. The other thing to really be concerned about, and so what you really should be doing if you want to kind of take a look at your investment portfolio and think about it more from, how do I recession-proof this? It's important to look at and upgrade the quality of what you own, the quality of the stocks that you own, and the quality of the bonds that you own. Far more important to do that exercise rather than, I'm going to increase the bonds up by 20%. I'll decrease the stocks. That's how I'll do it. Good luck on that, okay? Because I don't believe you can tell the future on a consistent basis. But what do we mean when we talk about how do you upgrade the stock portion of your portfolio? Well, here's some interesting things to consider, because if you look at, and this is true even for the traditional value indexes that are out there, and this is where we're going to see one of the shortcomings that'll pop up as it relates to indexing and index investing. So you may think, I'm going to own a value index, and then that's somehow how I'm going to improve the quality of my portfolio. We would urge you to hold off on that for just a second, because there's got to be a little bit of a deeper dive on it. So we'll look at the Russell 1000 Value Index, which is one of the biggest indexes out there and the most widely known in terms of quote-unquote value companies. Well, here's a couple of statistics about that index that may surprise you. Number one, 22% of the companies that make up the Russell 1000 Value Index, in fact, don't really pay a dividend. That's nearly a quarter that pay a dividend of less than 0.1%. How can you think you own a dividend-paying stock if it doesn't actually pay a dividend? 22%, nearly one quarter of the companies in the Russell 1000 Value don't actually pay a dividend. So that's what we talk about when we talk about upgrading the quality of the stocks that you own, looking for actual dividend-paying companies, and be careful of the labels. Because just because you're a value doesn't necessarily mean you're paying a dividend. Look no further than the Russell 1000 Value Index, which is, those are the 1,000 companies that are value companies. 22% of them don't even actually pay a dividend worth noting. Here's the other disturbing statistic. Again, when you look at the compartmentalization of value companies, Russell 1000 value companies, 40% of those companies are rated triple B or lower. Folks, triple B or lower gets you more into junk land. Triple B or lower is not a good company. It's not a great company by any stretch of the imagination. But yet you have 40% of the companies that are traditionally thought of as the 1,000 value companies out there, 40% of them are triple B or lower. So it's far more important to look at the actual quality of the company. If you want to recession-proof your portfolio and go to dividend-paying stocks of great companies, make sure they're actually paying a dividend, number one. And number two, make sure they're actually great companies. We got 22% of the index that doesn't even actually pay a dividend or pays a dividend of less than 0.1%. It's not really a dividend. You've got 40% of the companies in the index that are triple B rated or lower. It's not really a good company. Be careful of that. Be very careful of that. If you want to recession-proof your portfolio, that's great. Make sure it's actually a dividend-paying company and make sure it's actually a good company, not a crummy company hiding in a value index. Same thing can be said on the bond side. Upgrade the quality of what you own on the bond side. We talk a lot about the different types of bonds that are out there. And one of the biggest categories for bonds is a Morningstar category that was the intermediate term bond category. And what finally the folks at Morningstar realized is that there was a lot of cheating going on in that intermediate term category. And so they just recently split this category into a core category and a core plus category. Guess what the plus part means? The plus part means that you've got more than 5% of that portfolio that is in fact in high yield, a pleasant name for what we all know of as junk bonds. You've got more than 5% in that high yield category. So what does that mean? That means that that bond fund that you think is a very plain vanilla intermediate bond fund is actually cheating a little bit to get the yield, owning more high yield debt than you probably are aware of. And at the end of the day, high yield debt has a tendency to perform very similar to the equity markets when you go through tough periods of time. So upgrade the quality of your bond portfolio as well by actually looking at how much high yield is hiding in there. Because the reality is that high yield is very correlated to the overall economy. And what was happening in Morningstar's biggest category is that there was a tremendous amount of cheating going on, so they had to split the category. So they just did this year. So make sure that if you're looking at your bond funds, that you know where they are. Are they in this new core category or are they in this core plus category? Because if they're in their core plus category, then you own a lot more junk than you realize. We're going to slide to a break. When we get back from the break, we're going to finish that conversation on bonds and how to upgrade that and, in a way, try and recession-proof your portfolio. So we'll go to the break, we'll come back, and we'll finish up that conversation here on Dollars and Cents with Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. Welcome back to the program, ladies and gentlemen. Talking a little bit on this part of the program about how to recession-proof your portfolio. Going against the grain. And the reality is the vast majority of people say, oh, recession-proof my portfolio. I'm going to increase my bonds and reduce my stocks. That requires you to be able to foretell the future of the market. And the reality is that that's impossible to do. And what happens most of the time is you wind up ultimately reducing your rate of return over time. Far too easy of a move to make, and one that we think will not be beneficial for you in the future. But what you should be doing is checking out exactly what it is that you own. What's the quality of the companies that you own? What's the quality of the bonds that you own? We talked in the last segment about upgrading the quality of the stocks that you own and actually having good companies that pay dividends as a part of your portfolio. The problem is that most indexes these days, particularly one of the biggest ones that's thought of as the 1,000 biggest value companies, shockingly, 22% of those, or nearly a quarter, don't actually pay a dividend to speak of. That's pretty dramatic. And even more shockingly, about 40% of them, because again, a value company is often thought of as a distressed company or a company that's, on sale or it stumbled or it's got an issue. What you find then is that there's a lot of lousy companies in that group of value, to the point where 40% of them are rated triple B or lower. That's not a good company when you're rated triple B or lower. So make sure you're looking at that when it comes to your investments. On the bond side, we were talking a little bit about looking at how much high yield is in the actual bond category. This is such an issue in the bond side of things, that there were so many funds, bond funds, that were just cheating to get a better number and a better performance number to attract investor dollars, that finally Morningstar said, wait a minute, this is silly. We're going to have to split up our intermediate bond category into two categories because there was so much cheating by bond fund managers in order to juice the return, in order to juice the numbers. So now there's two categories. There's a core category, and then there's a core plus category. The core plus category is the category that has those bond funds have more than 5% in high yield debt. What's another name for high yield debt? We'll go back to the Michael Milliken days, and it's called junk bonds for a reason. So what that means is make sure that the quality of your bonds is, in fact, good quality bonds that are not high yield bonds, that don't have equity-like behavior when times get tough. The other conversation that we would also mention is this conversation about duration. We actually had a call last week on that. And the reality is that the shorter the duration you have, that shorter duration is really more beneficial in kind of a rising rate environment. And obviously that's not what we have right now. So instead of looking quite in the shorter duration, maybe that intermediate term, particularly knowing this distinction that exists between, in that intermediate term area, between core and core plus, is an important way to try and upgrade the overall performance of your bond portion of your portfolio, particularly during tough economic times. So certainly some concepts to be thinking about in terms of how to recession-proof your portfolio. In other news, I was listening to one of the ads that were running during the course of the last break, and it did cause me to remind our listening audience that we have a shred day coming up at the office, not this coming Friday, but a week from Friday. And one of the things that we will also be doing beyond just the usual shredding is we'll also be having an IT specialist there who will also help to destroy hard drives. He actually has a hard drive crusher. And so if you've got old cell phones or old computers that, are around the house and you just don't want to throw those in the trash, because you really shouldn't throw them in the trash because they've also probably got some important personal data on them as well, we'll be set up to take those and to take the hard drives and to destroy them and dispose of the computers and cell phones properly. So our shred day also includes a little bit of that IT side of things more than just the paper, because the reality is, right, we all shred paper, and we're all very cautious of that because we're concerned that our identity is going to be stolen because I've got my Social Security number written on a document somewhere. The reality is that what we see in today's world, it's really more about the digital side of things that is where the identity theft occurs more than kind of the old paper. I think, I'm not saying not to shred, you want to keep shredding, but the reality is it happens more on the digital side of things these days than it ever does on the hard copy paper side of things. You don't have folks rooting through trash, or you probably still do, but not as many, because it's much easier to do it from a technology point of view, because then you're even more invisible and you capture much more information. So our Shred Day is going to also include the ability to destroy electronic devices as well. So if you're a client of the firm, you'll get an email this coming week that details a little bit more about what that process is and what you need to do in order to take advantage of that. So look for that here at the end of this week to give you some specificity and some specific guidelines as to how to go about doing that. But rest assured, we will certainly include that as part of the Shred Day, because a lot of the information is stored digitally, and that also needs to be addressed and destroyed as well, just as much, and probably even more important in today's world than the paper part of things. So look for that. We'll get that on out this coming week, probably on Friday. And enjoy the rest of the week that was. Hard to believe, right? End of the third quarter. Man, October is coming up right on Tuesday. How quickly the year is flying on by. I'm sure we'll see Christmas in the stores in another couple of weeks, right? Hopefully not quite that early, but nothing beats the prolific spending behavior of the American consumer. Of course, that's pretty good for the economy too. So keep on keeping on, if you will. We will wrap it on up and get on out of here. Thank you for listening into the program. This has been Dollars and Cents with your host, Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando.